What's going on, everybody, and welcome to another weekly technical video. If this is something you're interested in, just a reminder that I do also provide a pulse on the market, a weekly pulse of the market. So, current events, earnings, and I get you prepared for the week ahead. That sounds like something you're interested in. Consider subscribing, as I do also provide a daily pulse on the market at Hemi137 on X if you want to check me out there. Before we get started, remember to hit the like and let's go ahead and get this thing kicked off. So, technical wise, we've seen some pretty big red candles over the past, essentially, since we've entered September. Things have been pretty rough. We've getting a lot of weakness essentially going on in the jobs market, something we've been talking about for a while. The SOM rule has been triggered. Now the market's pretty much starting to sell off in anticipation for potentially rate cuts starting to adjust. But again, I think that is a very long, drawn out process. But I think next year could potentially start hitting panic mode, especially with the unemployment numbers or where they're at. I talk about that in my other analysis video. So I highly advise that you check it out there. Now, as far as technical wise, this is something I've been talking about. Is this the current all-time high level? So roughly around that 5667 number. We or 670 number. I think we've been really kind of battling this. And I said if we couldn't make all-time highs, that would be highly concerning. We've been rejected once again. I wouldn't be surprised if we attempt to try to retest this, but ultimately, as of right now, again, there is a sentiment that is occurring with the job numbers, and that we are in a recession, despite what the media is saying. So, that being said, we broke below the 20 and the 50 over the past day. Expect a retest of this at some point this week. So try to pull back to the 5,500 mark potentially this week, and then potentially aiming for that 5,300 as of right now. Again, when you're talking about a recession and pricing in a recession is about 42%, and that is really going to be dictated by the essentially the size of the rate cuts. And I talk about this in my other video again, that you need to be watching to see if it's anywhere between 50 is a more committed, okay, this is somewhere we want to go. 25 is more so like, okay, we're just trying to test the waters as far as rates. And then anything from like 75 to 100-point basis move is panic mode for the Fed. So that is really going to dictate how this is going to move. But I do feel it's going to be pretty choppy, but it's going to come down over the next year. It's going to take some time. It's not going to be a quick. Now they could start emergency rate cutting. That is sheer panic if they're doing 75 and they come out and start cutting even at a rapid rate. So we really have to pay attention to the size of the cuts that are occurring and how this could potentially play out. But we are looking for we've had one big bounce off the 200 down here. So if we head back to this level, expecting a pretty solid bounce at the 5,300. That is the true test. If we break the 5,300, I think we're going to probably butter the 4,200 or the 5,200 down here, and then attempt to aim for that 5,000 mark, essentially down here is where we could be heading towards as we start pricing in these recessions. And a lot of these bigger red candles that we're going to see is going to be based off of events. This is why I'm very event driven, very supply and demand driven, because the events kind of lead you, will be that event that essentially causes us to break the support and starts moving down more. And then I believe we're going to see rallies straight back and then more breakdowns. So again, we'll continue to watch and see how this plays out. But this week, looking to see if we can hit that 5,300. Looking for a bounce there, like I stated, to potentially retest back up to the 5,500. And then I think that may be our weekly move potentially this week if we don't get any more real bad news. Again, right now we're walking on eggshells. There could be a lot of events that occur that could just cause this thing to just sheer panic. Like here was the yen carry trade, and you can see the damage it did just in the over past couple of nights. And so expecting something to potentially happen that as well here. So you need to really watch out. But once we break that 5,200 level, the market's really in some trouble. So that's really our key level we want to be watching throughout this whole process. I'm going to go ahead and jump up to a higher time frame here, as my laptop is running a little slow today, but 50, that's a 42 mark. So when I talk about recession, that's kind of what I'm talking about. The guesstimate, we can be less or more than that. So you have to understand we are dealing with data that's been, we haven't seen since essentially the late 1920s, and that could be a huge problem when you're talking about these things. So again, very key levels here. I could almost highlight this one. The 4100 level is a level when we actually started to cut. This is when we started to cut. As you can see, we pretty much have gone straight up since that point, which was back in October of last year. We normally have a really big pullback around this time of year. I talk about this when we came into this. So we could end up finding ourselves either around the 5K mark or potentially around the 4,700 mark by the time October is done rolling around. That really depends on the momentum of what's going on with the market itself, what news we're getting. I think the new year, once we put a cap on everything, we get the debt ceiling back and not stop all this free spending, it's going to really correct pretty hard quite a bit of times next year, especially next March. So I think what we could end up doing is finding ourselves maybe around this 4,900 level or the 4,700 level, and then start to do some sort of rally back to the 200. Now, I'm really projecting here. Obviously, we still haven't broken the 5,200, but it is a very key level. My thing is that we've continued to get rejected around again, the all-time highs is not a good sign, in my opinion. I've seen this multiple times, especially around this time of year. If it keeps getting rejected, I wouldn't be surprised if we attempt to try one last time. So this week will be pivotal. It's really heavily on the core. So if the core comes in greater or less than expected, I think that will really kind of dictate the move. If it comes in a little bit better or on average, maybe we go try to retest all-time highs. The problem is, again, we reject again there. That is going to be a really bad sign. And we'll start coming down. So we're going to talk about rate cuts because it's more than just about a rate cut. It's what's associated with that rate cut. What's the reasoning behind that rate cut is really what's going to kind of dictate how this thing is going to play out. And again, I think it's just going to be like 2022. Well, if we look back at 22, I can even drop this down to the monthly here. So if we look back at 22, this is when we started rapidly increasing rates. I think we're going to get the same thing when you start looking at rate cuts for this year. It's going to play out much like this. You're going to get wicked candles down and wicked candles back up, but it's going to continue. It's going to start downtrending at this point. Now you start talking about a 42% correction. That's even a lower low than this, which is concerning, but ultimately understand the market's designed to go up. So what the problem is, you need to flush out a lot of these current inflationary prices. So, but that's what I'm anticipating going into this next year. I've always stated, I don't like to project too far ahead, but again, still very early in the cycle. But the fact that the Fed are pivoting is what I'm trying to display here on the technical aspect, and what you can kind of expect is I'm seeing more of this, but I believe you'll see bigger candles to the downside because of the sentiment, because of what's going on, because of unemployment, because of housing, and because of all these the corruptness is that it's unwinding. You're going to start seeing this hit some of these levels again, and so I want to point out a lot of these really important levels. That low there was around, again, the 35. I talk about this level all the time, as that was right after Powell, and how we had this massive candle like in one day that was like 110 points on the SPX, which was absurd. And essentially we have gone up, and then again we paused right here, and that continued to rally into this year. Again, you have to remember right around this time as well, we got rid of the debt ceiling. So this is why our events are important. So every time we come back around to these things, we can look and see, okay, well, would make sense. That's why how the market pivoted. But ultimately, again, right here, the market, uh, the debt ceiling came into place. So they removed the debt ceiling, allowed free spending. That is essentially what helped us carry up here. We were adjusting rates along this way as well. And then removing the debt ceiling at least pushed us back up over this level. And then we had to officially pause at this level, and that's what caused this last hoorah to push us back over to all-time highs. So these events matter again because of history. Looking forward, when these events occur again, you know how it plays out, and they're always very similar in a lot of aspects. Strong and resilient, strong and resilient. Right? They're saying that a lot through this whole sector here to get this propped up because they were trying to break all-time highs at this point and they couldn't do it, and the market started selling off again because it was worried and concerned, and then they had no choice but to pause rates, and that essentially caused this one last push up. So this whole last couple of years have just been last 2 years have been a hot mess, and understand that they really do whatever they can in their power to get this thing pushed back up, because essentially the U.S. is the only country that's really heavily invested in the stock market. So again, this thing by design will continue to go up. So expecting a huge, especially with all these green candles, expecting us to at least correct and down to the 46 level at some point, I think over the next couple of months. And then again, with the aggressiveness of the Fed cuts will really dictate where we land. It's important to know where that 42 mark is because that's on average of recession. If we're talking about a 1930s crash again, that which is 80%. So you would still add more onto that. So a lot of people, some people in the business are talking about even deeper levels of the 2000s down here, which could be a possibility depending on how it is. If this whole thing really unwinds, but they've gotten very good about manipulating the market as I've talked through this and how this has kind of played out. And again, the official pause that has caused us to push up. So yes, it's good to know your technicals, but the one thing I've always stated about technicals is you don't know the events. This is why you need to understand what events are occurring, because it forces you to kind of determine the amount of risk you want to put onto this thing. Yes, it's designed to go up, but if you just keep buying candles, you don't want to be buying candles up here on the top, right? Like, is there a specific event? Like, this was tied strictly to an event with Powell. You could have bought this candle and went pretty heavy around this sector here because you're on a major support, and you knew there was an event with Powell. Powell said they were pausing. If you knew the cycles, you would know that after a pause, the market rallies for a couple months after the fact, and that's exactly what we did. Now we're talking about rate cuts. You talk about rate cuts, you start looking back at 2008. This is another very key aspect here is here, October. So this is kind of where we're at right now. So when you're looking about October, if I could zoom in, that would be fantastic. But as of right now, I gotta love TOS. So let's take a look at 2008, right? In 2008, that's December. So roughly in October of 2008 or 2007 is when we started to cut. It was a 50-point basis move, was the first one in September, and then you had 225 points to finish out the remainder of the year, which would put us right here. So the market started to sell off pretty heavy at that point. And then you started moving forward, and then the rate cuts around March started to get pretty heavy. So we started getting more cuts. So we pretty much sold off for a couple months going into 2008. And then we had some sort of a rally in April, which April is typically normally a pretty strong month. And then we started getting some more cuts, and then a lot of the banking stuff started really falling apart. And it wasn't until December of roughly around the last 3 months of the year, so Q4 of 2008, what was happening was everything just started absolutely crumbling. So September of that year, everything just started to get crushed. The whole housing thing started unfolding. A lot of things were getting really bad. They're starting to being 7,500 point cuts at that point because they just couldn't get the economy rolling at that point. And that's when we had these massive candles to the downside. And so again, you look back at September, so we're in the same exact spot again. So let's go to September, and then let's draw this out. Again, on average, is a 42% correction on the market. Whoops. A lot of technical difficulties this morning. And so over a roughly about a year span, you hit bottom towards the back half of September. This thing is not working for me today. So let's see. Sorry about this. It is really early in the morning too. So I'm just going to put that out there. So September, let's see. We're looking at September and then till the bottom of this, that's a 53% correction on the market. And so this was the great financial crisis, and understanding the rates and how this played out. We're looking at the exact same thing when you're looking at this. And that was just a 53%. So that was even more than the average of 42. Again, could be less, could be more. But again, like I've stated before, what you're dealing with here now, because of this move, you should know that this move was a pandemic. This was printing of more than 40% of the money supply, which caused this massive rally. Then you started getting cuts around this section here. Again, panic mode. Really going into this here, and then ultimately understand that at that point, strong and resilient, they were able to push the market up, but it wasn't enough. And the market started selling off again, had to cut rates, caused the market to start rallying. So it's good to know your history and how this plays out. And so now that you have more money in the system, you're getting much larger moves. And again, this is this is amplification of this back in 2008. And when you come to banks and everything else that's going on, we've already lost more money in a couple banks that we did in total with all of just SVB in itself was almost lost all the money that we did back in 2008. So imagine how much more of a move you're going to get because of that. And I understand the volatility of this is going to get a lot worse in future because of the money supply, and we're not backed by anything until we start backing everything by gold again. Right? This is only going to get worse. These moves are going to be a lot more volatile in the future, and so. But it's good to look back and kind of see, because we are looking exactly how we did back in 2007. Problem being now, though, too, is now you're dealing with a lot of inflationary problems, right? And so this is why there's a lot of people are discussing about a potential super cycle of commodities because of the rapid rate cuts we're going to have to do because of unemployment and how that feeds into oil. Because right now they're doing everything they can. OPEC is doing everything they can to try to get it propped up. But it's not enough, and oil is continuing to sell off. So that's a huge problem. Now let's take a look at Bitcoin. Bitcoin looks like it's breaking down on the monthly. Something I talked about previously is I'm not concerned about this because you've had these massive candles up and you haven't had any 50% correction. Now, 50% correction would say that we would at least drop down to about 43. I think we could potentially even hit that 35. I talked about this level for a minute. I think we can briefly touch here, and before we may start making all-time highs. Again, I think you need to recover, 50, 60% of this to be able to start making back to all-time highs. I think is what we're looking at when we start looking at our bullish cycle. When we start printing money again, it's all anticipated what's going to happen. People are thinking they're just going to start printing and things are going to come back fine and dandy, but like we look back at the 2008 financial crisis, it took about a year to really sell off, and then it recovered. It took a decade to recover, right? This You only have a huge correction like this in every decade, but you'll have other minor corrections throughout that decade, and we've seen that over the past decade. But ultimately, you need the major reset to reset pricing and everything. So that's why I think this thing could potentially come down to 35. I don't think it will last there very long. So do keep that in mind. But I think once it hits that, it'll probably be down there for maybe a week or two, and then this thing might start wicking back up and start making all-time highs. A lot of the price predictions at 500 a million, I think, is kind of absurd. Again, you're still based off an economy and demand. It's always supply and demand. So there's still a lot of mainstream media is pushing the thought and the idea away of cryptocurrency. So we'll see how that plays out. But nonetheless, that's kind of what I'm looking at there. I'm looking for this thing to at least try to come back and retest at least to the 61 last time before it rolls over. The market itself might do the same as well. So that's what I got for Bitcoin. As far as oil, I think this is important to bring this up because I was just talking about this. But they're talking about a super cycle, and it would make sense. You're at a strong support right now at 66. I think what's going to happen here, like I stated, with all the rate cuts, this thing potentially might start really rising to all-time highs and really ripping, especially if you're talking about having to do massive rate cuts because of what's going on with unemployment, and the numbers are getting worse. And I talked about how it's going to accelerate a lot more in your oil play. Like I said, will at least break out to the 120. Really needs to, again, hold this support here. You do have some smaller support here at this level here, roughly around this level, around the 59, 50 mark right here. So could potentially come back down one last time before ripping all the way back up, but we'll see. But ultimately, I think oil would be a good one along with bonds here. I know I'm kind of flying through these. I just want to kind of talk about the commodities because these are really going to commodities and bonds are really going to matter going forward over the next couple of months compared to a lot of the other positions. And understand that right now too, they're pricing in the end of the world, so you can't really make anything on options. You're either going to be in equity or you're going to be in futures at this point until a lot of this starts to shake out and resets a lot of this stuff. But right now, as far as bonds, we need to break over the 100 on TLT, which we start getting rate cuts. Again, depending on the size of the rate cuts, if we get like a 100-point basis move, this thing can really start gapping up. Are we going to see these 180 levels again? It's really hard to say. Are we going to see zero rates again or close to zero? I think that's really doubtful. But one thing I can say is I do believe we can at least hit this 120 level. I think is a strong possibility. That's kind of where I'm aiming at. Maybe even up to this level, to the 140 level, is a potential possibility too. It really just depends on how the market looks and the Fed's actions to that point. But again, if they're panic mode, 75-point basis move, 100-point basis move, this thing's going to really gap up to these levels. And so, again, bonds and commodities are something I'm really looking at over the next couple months. And then from that point, I'm be looking to buy a lot of these other growth stocks after the fact. So that's what I'm looking for there. Again, if we get rejected for bonds, I think the bonds will kind of hover around this $100 mark, maybe even drop down back down to the 93 mark one last time before it really breaks out. So really kind of watching that there. And then Tesla, like I stated before, Tesla is going to continue to play this. It sold off just enough in this month, and I think we're going to revisit the 169 at least. We'll see what the pressure looks like to the downside for when we start talking about rates and pricing in a recession and where it holds. I wouldn't be surprised if this thing actually breaks out briefly and heads down maybe to the 100 level. I think at that point, you really have to have a lot of momentum. You're talking about monthly candles here where they can wick down to about the 137. Like I said, this move down, I think, may be quick. Like I said, you're already living through the recession, so it's just the market price sitting in. So it may only take a month or two Looking back at 2008 crisis, right, it kind of played out throughout the whole year. I think you might get a little bit more of an acceleration of that, like I said, because of the fact that you were dealing with you've printed more of the money supply, so I think it might be a little bit more volatile. But I think a really good level here is essentially the 174. So really kind of watching that level and really be DCAing on Tesla because they in October 10th they're doing the whole robo taxis and humanoids. I've talked about this multiple times, so that is a really key level for me that I really like. We need to break this 206 level. We did briefly just last month and tag a little bit here at the 180, but I'm expecting it to at least come down to the 160. Kind of really expecting it to hold there, even despite we priced in a recession. But again, I wouldn't be surprised if it does come to some of these lower levels, just because of the amount of fear that you may get. But ultimately, I think it's going to play out to where this thing has the momentum to start pushing to the upside. So really kind of watching that there. Now, Palantir just got included in the SPX on Friday. So really kind of watching this here. It's breaking back out over the 32 right now. So this thing may start to run again, even with all the great news. We did get a big spike in it already. But with that being said, what you're looking at is the market sentiment is not good. And even though this is a great company and everything, if the market sentiment starts really selling off, it might start pulling back at least to 25. It might be the last chance you get below 30. Again, depending on the momentum of what's going on, expect this to break out of this channel at some point and actually start selling off a little bit. Now that it's actually been included, I think you can get a run off of the inclusion, but ultimately understand I think it will still correct once the market corrects. Maybe just below the 30 mark. Getting anything below that, it really depends on how bad the market gets. But we'll definitely have to see what happens in moving forward. But again, key level up here. Again, I think it's currently holding right here, so we have to see how the market opens. It may get rejected just because the market sentiment. But ultimately, because market sentiment does play a heavy influence on how these things, now that the events actually occurred, we have to see what happens and how the price action acts around that point. But if for some reason it wicks and stays within here, this 32 level, again, this is a monthly, so by September we may see it pull back to the 26, and then kind of take it from there from that point. But again, it's breaking out of this channel to the upside, so we'll see. It has a lot of great momentum. It's a great stock that I really like as well, but kind of seeing where it goes from here. Now, Amazon, again, starting to get some downside pressure. It needs to, I don't expect it to hold above the 177 here this week. Expecting a pullback to the 158, and then that will be your current support. See if we can hold there. If not, might be headed down to 145. I think a major correction, you're still looking roughly right here at the 120. I don't know if we'll get this low. Again, this is the 2022 level. If the market goes lower, like I said, if it gets into the 2000s, again, you obviously have to have a lot of fear and momentum to drive it down that far, but it has the right pieces set up for that to happen. So we could potentially even see a lower, or maybe flirt with getting this to this lower level around the 100 mark. But I think big tech, that may have been the low we had seen in 2022. But nonetheless, I think we could still get close to that. So I like the 126 level heavily for Amazon. You may get some wicks that come even down close to 100 and maybe brief, like I've stated. I think a lot of these candles that come down that I talk about, some of these lower levels, I think there will be very brief. You may only have a couple days before this thing, you can catch it there before it starts ripping back up. But we're going to have to see how that does play out. Shopify, I do really like Shopify too as well. This thing, I think, needs to break this current trend, which it's attempted to, but been bought up. I think right now you're really watching that 62 level. If it breaks that, you need to break this 52 level. And then I think you could potentially see this jump all the way down to the $33 level. I think it's a strong possibility, especially with Shopify can get quite hairy a lot of times, and it sells off pretty heavily quite quickly, despite it being a really good company as well. So I have to watch and see how this does play out. Its current ceiling right now is roughly around that 75. So we'll see how that does play out moving forward. Let's take a look at SoFi. I do really like SoFi. It's been pretty choppy. I don't really like financials, but I like SoFi quite a bit. Uh, Again, your major support here is at that 650 mark, so it really needs to hold there. If it does break below this, I can see us at least try to revisit the 512. Again, depending on the momentum, I think this particular stock is still trying to build its name, so we could potentially even see close to the lows of the 450. Could be a strong possibility for this one. But it definitely needs to reclaim the 770. I just don't see that happening anytime soon, at least in the next 2 to 3 months, or next month anyway, or 2 months potentially, because of what's the current market sentiment that's currently going on. So, and then we got, did I pass BA? I must have passed BA. There's BA, our lovely BA. Yeah, this thing is somehow, it looks like it's starting to get momentum to the downside. So it looks like we're aiming for the 140 this week. So this is kind of a double zone here. Ultimately, if we can get it down to the 121 is really what you're looking at. But I think this thing is starting to already get momentum as it's starting to break this 164, which is a critical level for it, which is now going to be resistance. If it can't reclaim that by the end of the week, I think it's definitely going to be a problem moving forward. So, but my target for this again is sitting roughly around that 125 mark. I think is where we're headed over the next potentially a couple months. Like I stated with the 2008 crisis, it slowly rolled off, but it was continuously selling off. Starting in 2007, had a bit of a rally in 2008, and then it really started selling in 2000, about back half of 2008. So I said it doesn't really matter who's sitting in office. This thing will unwind by next by next year at some point when you start getting the debt ceiling back and you cap the spending that's going on. And then JP Morgan starting to sell and needs to hold to 212. But again, considering this massive move here, you're kind of looking this thing to correct at least 50%. So you're kind of looking for it to come to the 156. I think when this whole thing actually unwinds, I think that's kind of what you're looking at right there. But you do have support here at the 196 and support at the 178. Again, I think it's going to be choppy, like I showed you in 2022. I think you're going to, like I've always stated, this is what the market always does. It'll bounce off support, and then it will break, and then it will do a bounce, retest what was old support, which is now resistance, and then continue to chop down. I think is what we're kind of looking at over the next couple months for a lot of these. And then HIMS is another one I want to bring up. I do like the business model, especially when you're talking about, I've brought this up a couple different times. I've been looking for essentially a healthcare play for the next decade. I think that would be good. HIMS kind of matches that. United Health is another big one I really like too. But this one I think could potentially play out even better just because of future generations, the biggest working class essentially retiring, and Gen Z supporting them and taking care of them. They're going to be more likely to come to HIMS to be able to get products and stuff for that. And so I think at this point, so we're really kind of looking at the $10 mark and this current support right now, which is roughly the 15. We'll see if this can hold this. But kind of really looking for this thing to pull back to 10, at least the $10 mark, which is a strong support. We'll see if we can break lower than that. I think, again, some of these levels, I think we have been in some rolling recessions, so I don't know if you're going to see that big of a sell here down to these levels at the $2 mark, but I can really see us holding the support here roughly around 10, maybe in a brief stint at the $6 mark. Before we start rallying at that point. Again, the rally I think isn't going to be quite as intense as it's been. You're not looking at back in during the pandemic. That was a once in a lifetime event where they just printed massive amount of money. I do think they'll start printing money again, but I think to a much smaller extent. So we're gonna have to see how that does play out. But this is a very long video already. I had a lot of conversation. I wanted to break down SPX and kind of show you really what was going on there, and then kind of take it from there, and we'll see what happens. So with all that being said, if you made it this far, go ahead and drop a like. And until next time, I'll see you guys later.